Hello and welcome to BQ Prime. A very good afternoon to all the viewers. I'm Hiral Dadia. One sector that has been buzzing over the last couple of trading sessions is real estate. Clearly, if you see in terms of the real estate index as well in terms of yesterday's session, we've already seen a record high. I think a level that we've not seen in the last 15 years. And what's fueling this rally? The kind of Q2 quarterly updates that builders, I mean real estate players have come up with, is that actually giving you the correct picture going ahead as well? Joining us on the show to discuss more in terms of trends is Gulam Zia, Executive Director at Knight Frank India. Gulam, good afternoon and welcome to the show.
Good afternoon, Hiral. Good to hear that the sector is doing well, and the summary that you've put up is really heartening. Thank you.
But it's always a pleasure to see something like this, right? I mean,
Indeed.
Clearly the demand seems to be at a 6-year high. Third quarter 2023 record sales is what we've seen overall. And you have mid and high end, which have recorded a rise at the cost of affordable homes. And that was one of the reports that I was reading by Knight Frank as well. What is the actual trend that you're picking up? And is this something which the markets are pricing in?
Well, the volumes are very, very encouraging. The sales volumes, the transaction numbers have been increasing pretty much month on month in spite of adverse environments and things like, extremely high home loan interest rates and so on. So there have been worries all across, whether the global concerns or the Indian economic worries, etc. But net, the buyers are undeterred. So the transactions are going on unabated. While we would have loved to see the affordable housing segment also kickstart, because that has always been the biggest contributor to the real estate success. Last year and a half or two, the upper end, the mid and upper end are really doing extremely well. And the lower end has not been, as you mentioned earlier in your submission, the lower end is not doing well. Well, the reasons of that are very, very different. But for the sector to continue, we will have to get the affordable housing segment also bounce back. And we are really waiting for that, because there are some interventions coming from the government side as well, which are expected to give a new lease of life. So overall, where we see the sector from, things are going great. And one or two more interventions will only make it look much better. Over to you, Hiral.
Right. So, Gulam, clearly, the residential real estate market, from what we're discussing, has been on an upcycle over the past couple of years. Now, the momentum to sustain, yes, you need the participation of affordable housing, as you're mentioning. But is there a response to saying that, yes, the next 4 to 5 years, the bull cycle, the momentum will continue?
Well, if I have to rely on historic learnings, a typical real estate cycle lasts for about 8 to 10 years. There have been earlier instances where, due to some interventions or some global impacts, the sector was shortened. But on an average, we look at it for at least 10 years of a cycle, which means at least 5 years of an up cycle and 5 years of a down cycle. And we just about a year and a half into the up cycle. So when we talk about the real estate clock, we say we are about 7 to 8 o'clock position. We still have a long way to reach the 12 o'clock. And then from there, the downturn will begin 1 o'clock, 2 o'clock types. But we still have a long way. So to answer your question, we believe that next 4 to 5 years, the rally shall continue undeterred and will only improve if one or two of those sectors which I highlighted earlier also get on to the bandwagon. Then we have nothing to worry about for at least next 4 to 5 years.
Right. So, Gulam, I was looking at data published by various agencies, which is indicating that the pan-India residential launches and sales, if you have to look at the top 7 cities, and say over calendar year 20 to 22, it's a CAGR growth of almost, say, 67 and 62% respectively, which was approximately 15 and 12% over calendar year 19 to 22. Now, if that's the kind of improvement in growth that we are seeing, and the launches and sales momentum have sustained in the first half of calendar year 23, how is the inventory pile up looking like?
Well, first of all, I hate that term pile up. Inventory pile up, overhang. There are a lot of these terminologies thrown at our audiences and it creates lots of confusion around. Let me put something in perspective. Inventory in itself is not a worry. In fact, it's a good sign, because if inventory is under pressure, there is less inventory, then the prices will shoot up. And number two, something which we have to also relate to is that while inventory is going up, how is the sales velocity catching up? If the sales velocity is far better or more than the inventory pile up, then that inventory itself is short. So right now, as we see, the velocity of sales in last 2 or 3 quarters have improved a lot. There is one more factor which is also important to be thought about or kept in mind in our analysis, is the amount to be the time taken to exhaust this inventory. And believe me, the time taken to sell all this inventory that you're talking about is shortening. So earlier we would look at about 8 to 9 quarters to get rid of the whole inventory at any given point of time. It has come down to 7 to 7.5 quarters, which means inventory has to actually pile up more for the prices to remain under check. So my worry is the other one. If inventory is not coming up more and more, then I may see some price hikes happening and the affordability can be thrown out of the window, because ultimately buyers are here only as long as the products are affordable. And that's where the economy of demand supply kicks in. And I would want to believe that the inventory has to go up more from where we are. So there is no worry on inventory from front whatsoever.
Right. And how is the average property price coming along? Because I mean, 5 to 7% CAGR over, say, this from the second quarter of 2020 to the second quarter of 23 is what we've seen. And yes, there has been an increase in construction costs. The demand environment has been healthy. But from here on, how are you seeing prices pan out? Because I was talking to a couple of developers in the last couple of days, and they are of the opinion that they will want to maintain prices, taking into consideration the way demand is panning out, and make the most of it.
Bang on. This is exactly what our observation also has been. The developers, at least the ones who are active in the market today, have learned their lessons. Most of them are the ones who have actually survived and sustained the whole COVID downturn. And even before that, real estate housing was really in a kind of a almost 4 to 5 years of a bad patch. So here are the developers who have sustained, who have survived that bad patch, and here they have learned their lessons. And one of the key things for them to pick up is affordability. While there are two sides of at least three sides to affordability, cost of construction is one. Another important thing is the home loan interest rate. Home loan interest rate is already shot up. Cost of construction has remained pretty, I would say, stable. The developers have learned that they will have to maintain the prices to continue the sales velocity. And that's very heartening to note that the developers have learned that lesson. So as long as the prices remain under check, and as the numbers that you spoke about earlier, about 6 to 7% CAGR kind of a price growth is manageable, because it is still linked. When you look at the inflation as well, you are actually inflation negative. Inflation at 8-9%, you are still at least a percent or two, at least 100 to 200 bits below inflation. And that's a very welcome sign for the price movement. So as long as we have 5 to 6% per annum kind of a growth in home prices, we are absolutely affordable and we shall remain affordable. The other side of it is the home loan, which I spoke a short while back. Home loan interest rates, as we see, have already peaked out. And the moment home loan interest rates start climbing down, we shall have another lease of life from affordability side. And people, a lot of them who are waiting on in the wings, sitting by the fringe to see that home loan price coming down, then we'll see another bulk of buyers coming in the market and transacting. So a lot of good time ahead in a short.
Right. So with this, you've mentioned about that. Yes, the supply from an affordable housing perspective, demand from there needs to pick up. How do you see that turning around? Because uh, clearly the ticket size split again in terms of the third quarter, we are seeing some bit of changes coming in there. How are you looking at it? Do you think builders are focusing, real estate developers are focusing on affordable housing? Because even if you take an example of a city like Bombay or Mumbai, clearly a lot of redevelopment is coming into play now, right? I mean, you have very few land parcels which are left to do absolutely new construction. And all the existing redevelopment projects, majority of them, I mean, if you see ticket sizes, it's nothing. It's all somewhere in that range of 5, 10, 15 crores. Uh, and there are buyers, right? So you can't say that there could be a lull in that market, but how do you bridge that gap for the affordable housing?
Well, first of all, let me put something in perspective. When you talk about affordable housing, the key concern is not the demand. The key concern is supply. And this is
Supply.
something which you also spoke about, that the developers will have to see sense in doing affordable housing. And for that, even government needs to do some amount of intervention is to come. Like to me, the best environment for doing affordable housing exists in Haryana. The
Hmm.
Haryana government has created lots of those policies which make construction of affordable housing profitable for the developers. Otherwise, if you leave it open and affordable housing has to compete with the mid to upper end of the housing, obviously the developer who is also into building into the business for commerce would be tilted more towards there. But the policy framework are also going to play a crucial role over here. And second thing is, let me also highlight, you spoke about Mumbai. The numbers are startling. You know, in Mumbai, below 50 lakh apartments, to which most of us believe that in Mumbai, below 50 lakh is affordable. 45% of the apartments sold in last quarter were below 50 lakh, which
Wow.
means for a city like Mumbai, there is a huge amount of number of transactions happening in that segment also. And then if you look at the pan-India situation, while the share of the transactions of affordable housing has shrunk indeed, but it's not as if the demand is less and hence the transactions are going down. So two things are happening. The supply has been very reduced and limited. On the other side, of course, from the demand side, from the buyer side, the home loan interest rates have also jacked up. So the moment these two things are falling back in place, are changing towards the other end, we will see hordes of these transactions happening in affordable housing as well. But whatever said and done, we would need some good policies to ensure that the affordable housing comes back in the force, and something which is not yet formalized. The central government is looking at a special scheme for subventing the home loan interest rates a lot by about 3 to 4% reduction for the affordable segment, for which the central government apparently has set aside about 70,000 crore. The moment that kicks in, we shall see a new lease of life coming in for affordable housing, and we will not discuss this as a concern at all. We will look up to it as a yet another great moment for the markets to really cheer about.
Right. And so that's with residential. How are you seeing the commercial space evolve? Because there is that resilience that we are seeing, and this is despite the tech sluggishness as well as the global headwinds, right? So, how are you looking at it?
Well, commercial segment in India at least. And for this, you have to allow me to talk about the macro for 1 minute. You know, long time we've been talking about the whole world connected, and if one country or one state falling down, there's an impact on the rest of the global economy, etc. But in last 2 3 years at least, Indian economy has been largely segregated. It's on its own. Whatever is happening, whether it is the Ukraine-Russia war or the American meltdown or the European concerns, economic concerns, etc. India has remained kind of decoupled for a long time. That's the macro perspective. Now coming down to offices, office obviously is an integral part of the economic activities. You know, because the more of the economy growing, you will require more office spaces because you will create so many jobs for people to sit in office and work. And that is what has been a very welcome kind of a environment or situation in commercial. In commercial, during COVID, we saw a huge climb down because of work from home as a new trend, etc. But all that is behind us. Last year, we saw about 53 odd million square feet of fresh office absorption in the country. The best performance historically in India was 60 million. So we are inching close to that number that happened just a year prior to COVID. And we assume that even current year, we already are at least 3 quarters into it. The last quarter is in front of us. We would all be either going same number of breaching that 50 to 53 million mark in fresh absorption of office in the country, which gives me the strength and courage to tell you that office market is not as bad as what the global players would want to believe. While there would be huge concerns in the global office market, Indian office market is largely decoupled, and the way we look at it, the consumption or take up of fresh office stocks continues. And if it continues that way, I don't see any reason for you to have any concern about the health of office market either.
Right. So I think everywhere, I think that trajectory, that momentum is absolutely here to stay, taking the entire real estate's upcycle into consideration. Thank you, Gulam, so much for joining us on the show and sharing your views and insights, because this really helps, especially, when the markets are under pressure and you have the real estate space, which is really giving you records, and investors are really happy with it as well. Maybe not buying properties, but investing from a stock market perspective as well. Thank you so much for joining us on the show. But
My
moving
pleasure,
on,
Hiral. Thanks.
thank you. Moving on from the trends that we've seen to now understand what are the kind of stocks that stand to benefit out of this. Joining us on the show is Ronald Siyoni, Associate Vice President, Fundamental Research at Sharekhan by BNP Paribas. Ronald, good afternoon and welcome to the show. Ronald, my first question coming to you is, I was just talking to Gulam with regards to the kind of trends that we have been witnessing. And clearly, uh, residential market on an upcycle, commercial space absolutely resilient. What's your key takeaway out of it? Is the momentum here to stay according to you?
Yeah, good morning, Hiral, and thank you for having me on the show. So you rightly said that, yeah, we are actually to 3 years into the reality upcycle. The cycle began since the start of fiscal year 21. So the nine stocks we cover, they cumulatively have seen a sales CAGR of 55% over the last 2 years, which is also, collaborated from consultancy firms like Anarock, which have, in a recent report highlighted that there is a 60%, more than 60% growth in sales and launches in the top 7 cities. So yes, despite, FY23 till date, there's a 250 bips hike in repo rates and global hikes of around 500 bips in Fed rates. Still, the momentum has been strong in FY23. There are few companies which came out with Q1 FY24 numbers which have been very strong. So yes, the momentum is expected to continue. Yet we are yet to see, the interest down cycle. The Fed signaling a dovish guidance on interest rates, and the likely that the global rates may not increase as of now over the medium term, and there is a possibility of rate reversal domestically going into the next year. So we are yet to see the tailwinds of interest rate down cycle, and being a resilient economy in the period where there was a 250 bips domestic hikes in repo rates in India.
Right. So Ronald, with this, how are you looking at the way Q2 real estate quarterly numbers that have come in? If you have to talk about all of these companies, the Q2 numbers are absolutely strong as compared to what we saw in the first quarter. What is it telling you, if you have to see all of them, from a SOBA to a Macrotech to Prestige, Purvankara, all of them?
Yes, you rightly shared that these four companies came out with a very strong numbers for Q1. There is a strong YY jump in the sales booking. Some reporting almost doubling of sales value for Q1 of FY24. So for companies like DLF also, previous quarters have been like Q4 had been very high or a high base quarter, but still the momentum of around 2000 quarterly run rate for DLF should continue. Oberoi should also give a strong sales number for Q1 of FY24. So, realty companies for Q1 FY24 are slated to give, strong sales booking numbers YY. The sequential numbers are also good in terms of, improvement quarter on quarter. But if we talk about, revenue booking or say operating margins or profits, these are yet to catch up, as the companies follow most of the companies follow a project completion method. So this high sales number will only get reflected over the next 3 to 4 years down the line in the financial numbers, but sales booking numbers would continue to remain very strong for Q1 of FY24. More so, we are also seeing the launch pipeline of all these companies to be very robust for FY24. There are also new business developments going to take place during the current year, which would form a base for a launch pipeline for the next year. So yes, over the next 2 years at least, we are seeing a strong launch pipeline, sales booking momentum to continue, and so this cash flow increase would only help in new projects getting accrued for these companies.
Right. So clearly, I mean, that momentum that we have been seeing as well, that's what everyone is of the opinion that the sales momentum is expected to continue as well for major of the developers. The kind of improvement that we are seeing in the pre-sales numbers as well, and you have Nifty Realty, which is the lead sectoral performer this year because the kind of growth that we are seeing over there has been spectacular. The kind of tailwinds that we have been talking about as well have been spectacular. So that's with regards to where the overall real estate spaces. Ronald, coming back to you now in terms of specific companies as well, what is your key takeaway in terms of the second half of the year then? And from a valuation perspective, how are you looking at it?
So yes, considering the strong sales numbers which have been reported by these companies, stock prices have run up over the trailing 2 years, and we are now seeing that the valuations are trading above NAV, which is which is quite justified because the NAV premiums assigned to these companies like DLF, Oberoi, Purvankara, Mahindra Lifespace, Suntech Realty, Kolte Patil developers. These all companies are under coverage and these are trading above their net asset values. And because there is a strong visibility in terms of sales booking over the next 2 years. This is not like the last reality upcycle where much value was assigned to the land ownership and there was a premium assigned to which companies have more land bank available to them. This time around, the NAV premium is assigned to faster churning of projects in terms of sales booking. So there are new business models getting evolved where you are seeing JV or JD developments or redevelopment projects being undertaken. Faster coming to the market with the projects and churning the capital faster, which we are seeing in these companies. Also, leverage at that point of time, and now the leverage of these companies are at very comfortable levels. If you look at DLF, they are almost at a nil net debt to equity for its development business. Other companies, most of the companies are below 1x. Some are at 0.5x, like Macrotech and Prestige Estates. So leverage levels are comfortable. The sales booking have been high, so those cash flows which are coming, they would balance it out in terms of debt repayments and new project acquisitions through JV and joint development routes. So requiring less of capital for future growth. And we see there is still 20 to 25% upside in the stocks under coverage, which I mentioned, like DLF, Oberoi Realty, Macrotech, then Purvankara, Suntech Realty, Kolte Party Developers. So this all companies, Mahindra Lifespace. So this all companies, have a 20 to 25% upside still left from the medium term. And post that, we are yet to see as I said, the interest rate tailwind in terms of lowering of interest rates for the next year.
Right. But do you think these are good levels to still enter the real estate space?
Yeah, definitely, because we do not think that this is the peak of the cycle. We are 3 years in the cycle, but this peak is still a bit far away, and hence the valuations are not at that high levels that we can get scared. So there is still a lot of upside left in the realty stocks. Whenever there are opportunities of little bit of corrections, there is always opportunity to add on to the stocks. Even fresh buying can be initiated at the current levels for the realty stocks.
Right. So we're talking of companies, Ronald, with a strong residential project pipeline from what you're saying, who probably have a good ready to move in or ongoing projects as well, right, in terms of a pipeline. If you have to look at the commercial and retail segment, Where do you see a strong project pipeline in terms of companies, which could then probably see a good rise in the rental incomes in the coming years? Which bets could that look like?
I think commercial side is segregated into two parts, like office and retail. Retail, of course, you as you have seen the Phoenix numbers also and the consumption which they have seen. So retail is already doing very good, but commercial space is gradually improving, and it would not see a sharp uptick as we have seen in residential or retail segments. So commercial office space is on an improving trajectory, but it would take time. Rentals would take time to gradually rise. It would not be a sudden uptick in rentals. In the rental space, like DLF and Prestige Estates, hold a good amount of valuation that comes from the rental or annuity portfolio, and they have Prestige Estates, have a great or a bigger plan in terms of increasing their annuity income. But we do not have recommendation on Prestige Estates because of they would be going for a higher leverage. But yes, for DLF, we are optimistic on their rental portfolio.
Right. And my last question coming to you is, we've spoken about the demand supply. How is the inventory trend and the price trend panning out on an average? If you have to look at an overall basis as well as, city specific.
So overall, for top seven cities, the inventory position at the current sales run rate is less than 24 months. So between 19 to 20 months on an average for this top seven cities across. So the inventory levels at this sales run rate, at high sales run rate, is around 19 to 20 months, which is which can get absorbed very quickly if there is a limitations in supply. So there is no issue of inventory overhang there. In terms of pricing, there is around 5 to 10% price hikes on an average overall over the last 1 year. But there could be a project specific, like premium categories, or project specific pricing could be much higher depending on the velocity of sales. But overall, on a pan India basis, it looks like a 5 to 10% price hikes across the on an average category for real estate.
Right. So I think an interesting story, Ronald, that is brewing for the space as well. And that upcycle that we are seeing again, that is expected to continue. Thank you so much for joining us on the show and giving us those views. So that was a
Thank you.
conversation with regards to the kind of trends that we are seeing in the residential as well as in the office space. And along with that, the companies which actually stand to benefit out of it. And everywhere you're seeing that upcycle that has continued. Inventory levels have gone down. The demand supply scenario remains absolutely intact. However, for this rally to continue, as Gulam was mentioning as well, the participation of affordable housing is going to become absolutely necessary as well. There is good amount of demand, but the supply side needs to be fixed as well. And you need developers to come out and look at affordable housing as compared to the luxury as well as the mid-tier kind of homes that they're building. An interesting space to be in, not only from a purchase perspective, but also from an investment perspective. That's the view coming in so far from the analysts that we've been talking to. That's all that we have on this conversation. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.